When it rolls over and you're going to see the outflows, these passive ETF outflows, I think that it could get pretty ugly. You ask me what keeps me up at night? From a market's perspective, it's what happens if that panic sets in. There's a lot at stake. Everybody is all in. Everybody is all in. And that has me concerned.
David, I'm sure you would agree with me when I say we're living through some very interesting times right now, but there's also a lot of uncertainty. We have a new administration in the US that's going to impose a lot of new policies, and we don't know the exact details associated with these policies, but it's going to cause a lot of disruption. So I want to have a conversation with you focused on the economy and politics and also the policies that might be put forth and how they're going to impact both the US economy and also the Canadian economy. And I want to start with the US economy. And there's, like I said, a lot of things we don't know, but let's just look at what we do know right now. And the last Q3 GDP number, which came out, it was the third revision, came in at a very hot 3.1%. That was revised up from 2.8%. The non-farm, the last non-farm number that came out came in very hot at 256,000 new jobs, versus the expectation of 155,000 jobs. And then the unemployment number, the most recent one, came in at 4.1%, down from 4.2%. And when you look at all these various numbers, and I should also make mention of the fact that Jay Powell, during the last Fed meeting, did mention that he was concerned about the strength of the US economy. And he also signaled that he's going to have 2 rate cuts in 2025 versus expectations of 3.
How do you make sense of all these numbers I just threw at you? And do you think the U.S. economy is as strong as we're led to believe it is? And do you have any concerns about the U.S. economy right now?
Right. Well, Jimmy, thanks for having me on your webcast again. I want to go back to one of the first things you said, which is that we are in a very interesting environment. And reminds me of the old Chinese proverb about may we live in interesting times. But it's not really a proverb. It's a curse. And I'm superstitious. And if you're an economic and financial market forecaster and you're not superstitious, you probably should be, because we need all the help we can get. So speaking of China, in the Chinese zodiac, this is the year of the wooden snake. And the wooden snake happens every 60 years. So I think that's a little apropos, because we probably have with Donald Trump, Trump 2.0, a 1 in 60 event. In other words, as you mentioned, uncertainty, unpredictability, and we'll talk later about how you invest in this sort of world where there is so much uncertainty, and the confidence bands around any forecast are much wider than they've been, I would say, perhaps in our professional lifetime. In answer to the question about the data, I'd say that if you look at the data at the headline level, you got a U.S. economy that's growing pretty nicely. But I'm not seeing ratification in other pieces of information about the beloved U.S. economy. For example, the survey data that comes out from the Fed itself. We get the Philly Fed indices, manufacturing services. We got the New York Empire manufacturing. We just got the Kansas City Fed manufacturing and service. So we get these ongoing, timely, monthly survey data on manufacturing and services. And we have the most up-to-date numbers for January. We actually create a Z-score or a Z-score out of these surveys as corroboration for what the government data are saying, because that's what you cited before. All those numbers come from the Bureau of Labor Statistics, the Commerce Department, so on and so forth. No, the survey data are not flashing a 3% growth economy. More like 1. Now, not -1, so you can come back and say, well, it's not a recession. However, I'm pretty sure when you and I started in the business, God knows how many years ago that was, we got down to 1% on GDP growth. People would be asking, so when's the recession starting? It's what people like me and Stephen Roach, in the old days would say stall speed. So no, I'm not buying into all the government data. The Fed's beige book itself, the beige book comes out every 6 weeks. The Fed started doing the beige book in 1970. And it's interesting because it's not quantitative, it's qualitative. And it's a survey that comes out every 6 weeks. The Federal Reserve sends their staff into the field and interview business contacts across the country and across all industries. We just got the beige book 2 weeks ago, the most updated one. How to describe the U.S. economy. Describe the U.S. economy not the way you described it, okay, or how Jay Powell described it. The words, and we actually apply data science to this, and it's not a 3% economy. The words slight, soft, slow, modest. There was no words hot, strong, robust, buoyant. You didn't find that at all, okay? Now the word uncertainty showed up 6 times, which is rare. But no, I don't remember in my 40 years in the business seeing such a divergence between what the government's data are spitting out and what you're seeing in the survey data, the private sector survey data, and what we're seeing in the beige book, to which I would say to Jay Powell, who correctly talks about the strong U.S. economy because he's buying into the BLS data, to which I say, well, take the L out of BLS and maybe that's more appropriate. If you're not going to pay attention to your own beige book, why bother spending the time, money, and resources on it? But it's telling you a slightly different picture, okay? And so I would say the economy is softer than what appears when you actually dig beneath the surface. But certainly market participants are believing in the government data. The stock market, the bond market, the credit market, they believe in the veracity of the data. I'm not going to say that there's a conspiracy theory going on. What I will say is that, and this is especially true in the post-COVID world, and you mentioned the non-farm payroll numbers, they have been revised down 75% of the time in the past year. All the revisions are to the downside. The number you cited will be probably revised down when we get the revised data back in early February. And that's because the response rates, especially from small business, are much lower than they've been in the past. The response rates to the data that the government is getting, that they're producing back to us, the response rate is very low. Ergo, the error term in the data is very high. So I'm wondering, and this is what happened back in 2008, if you go back, the NBER, the National Bureau of Economic Research, they are the arbiter of dating when we have recessions and expansions. And when they told us that we were in recession in December 2008, well, what a big surprise that was. But most people thought the recession started in September of 2008 when Mother Merrill, and AIG, and of course Lehman all collapsed. But people were surprised when they dated the recession starting December of 2007. Nobody, so why? Why is that the case? Because the NBER, look how long they waited to declare the recession, December of 2008. At that point, it became pretty obvious we're in a recession. But they dated to December 2007. Why? Why? Because they wait for all the revised data to come. It's not because they're slow and stupid. These are PhD economists. They wait for all the revised data. So guess what? Next time you and I are having this conversation, we might be talking about a different set of economic data, post-revision. So color me skeptical. I'm not saying there's a conspiracy theory, but I'm skeptical over the quality and veracity of the government data that market participants are trading around.
I want to ask you about inflation now. President Trump wants to impose lower corporate taxes, also higher tariffs, deregulation, and deportation. And we don't know exactly how these policies are going to unfold, but many people, including Stan Druckenmiller and Paul Tudor-Jones, thinks these policies will be inflationary. What are your thoughts on that? And do you think the implementation of these policies will lead to higher inflation later in the year?
So here's where I come out of the debate on Trump and inflation. we have a sample size of 4 years, Trump 1.0, where he did all that. He did all that. Restrained immigration, deregulation, huge corporate tax cuts, and tariffs. Now we could argue about the scale of the tariffs looks to be quite large this time around, but we have a sample size. And people said the exact same thing after he got elected in November 2016. I remember vividly Larry Lindsey, former Fed governor, one of Alan Greenspan's buddies. And who's smarter than Larry Lindsey? Very few. He was on CNBC right after the election talking about reflation, inflation, and talked about interest rates going to 5-6%. Interesting. That never happened. Even before the deflationary detonation at the onset of COVID, even before that, all the different measures of inflation, producer inflation, import inflation, consumer inflation, and all the core measures were all at or below where the trend was when Donald Trump took office. How come people don't recognize that? And it's not as if he didn't have restrictive immigration policy and we had a 3.5% unemployment rate. And there was no massive wage acceleration. There was no, do you remember Trump's first term as being inflationary? Because I don't. So we're just back to the old claptrap of it's going to be all about inflation from Trump's policies. We'll see what happens with immigration. Will it tighten up the labor market? It's an assumption. What if I told you right now that there are more than 5 million native-born Americans out of work and looking for a job? Well, maybe now they'll get a job. There's more slack in the labor market than meets the eye. There's a lot of people, the labor force, the people that want a job, that can't get a job, that are native-born, not immigrants and not illegal immigrants. There's a very big pool of those people. So no, I'm not getting sucked into the vortex that Trump's immigration policy is going to create some sort of wage spiral. Deregulation, well, we know that over time that is going to lead to a lower corporate cost curve. That's disinflationary. That's an easy one. Corporate tax cuts. It works both ways. It stimulates aggregate demand, so you'd say, well, that's reflationary. True. But what else does it do? And that's why the corporate tax cuts in 2018 weren't inflationary, because as an employer, when your taxes go down, your margins get fattened. Therefore, you don't have to raise prices to boost your margins. The government just gave you that opportunity to widen your margins without having to raise prices to your consumers. Explain to me, what exactly is inflationary about that? Now, tariffs are trickier. But there's all sorts of assumptions. But remember that there's 3 players in this game of the tariff. There's the foreign exporter, there's the domestic importer, and then there's the final consumer. Who is going to bear the burden of the tariff? And everybody, when you're talking about Paul Tudor Jones and other people, well, their assumption is it's all going to be borne by the consumer, but it's uncertain. We do know that in the last go-around, the consumer didn't bite. There's no perceptible impact on inflation from Trump 1.0 and the tariffs he put in. On top of that, let's assume for a second that the whole burden goes to the consumer. Are the tariffs inflationary? Then you have to talk about, how do you define inflation? Inflation is a persistent rate of change. It is a process. We had pernicious inflation in the 1970s, not because of the oil embargo in 1973, but because OPEC raised the oil price each and every year. It was a wash, rinse, repeat. 7 years of repeated increases in the oil price. And over that period, they raised the oil price for an oil-dependent, foreign oil-dependent country back then, tenfold. And we talk about the 1970s. It wasn't a one-off in 1973. If all OPEC did was double the price in year one and left it there, we would not be talking about the inflation of the 1970s, but it was a recurring shock. We had 18 months of inflation in 2021, 2022. Why? Well, the economy reopened, and we had all this stimulus, but we kept on getting these rolling squeezes on supply from the supply chain shutdowns, especially in China. It was a recurring theme. So if you're going to tell me that Donald Trump is going to raise tariffs every single year to perpetuity, well then we're going to have inflation. But most of the time, you raise tariffs and you do it once. And it's a one-off level price shift. One-off level price shift, and then you move on from there. So that is not inflation. Inflation is a process. Now, someone come back and say, well, but if they do the price shock from the tariff and it falls to the consumer will then bargain the employer for more wages, and you get into a price wage and wage price cycle. And that's possible. It's possible if the labor market is really tight. You mentioned that the unemployment rate went from 4.2 to 4.1. You can trade around that number for a day, but to me, that's noise. To me, what's more important is that the unemployment rate bottomed at 3.5% for the cycle, and the trend is moving up. And it's not a straight line. So more slack, and you could see it in the JOLTS data. Like you can see exactly what's happening. Even though companies are keeping their firings low, nobody wants to get rid of their labor, the hiring rate has come way down. The hiring rate is like at a decade low. Companies have dramatically slashed their hirings. And that's telling you something about the contours of the labor market. It is at the margin softening up. So I don't think you're going to be having a lot of people bargaining hard for wage increases going forward because of the tariff. That's my assumptions in my business of forecasting. You know, your assumptions drive your conclusions. So I would say two things on the tariffs. Unclear how much of the burden is going to fall on the consumer. But even if I'm wrong on that, tariffs have to be a persistent. He has to raise tariffs persistently for it to cause inflation. Other than that, it's a one-time level price shift, okay? And it's no different than what we're seeing right now. What did prices do during COVID? They went up like, 20%, 20 to 30%. Prices aren't coming down, but the inflation rate's coming down. Prices aren't coming down. Prices rarely come down in the aggregate because so much of the pricing is in the service sector. Like you might find auto prices come down, furniture prices come down, but service prices tend to be sticky, and that's most of the pricing pie. So we revere Paul Volcker, and we call him the inflation dragon slayer. He slashed inflation, but did he slash prices? Prices never went down under Volcker. He is renowned, and there's a statue of him because he took a 14% inflation rate down to 4%. It's the rate of change. That's the inflation rate. It's not the level. So people who are talking about tariffs as being a source of inflation are not telling a complete story. It probably is, I think both in theory and practice, a one-off level price shock. So I can't, out of everything you asked, I can't get an inflation view out of it. And then I have to look at it logically. Because you have to be a lot of things as an economist. You have to be, you have to know the markets. You have to know psychology, but you have to know your history. And inflation brings down democracies. Inflation brings down empires. It is a social disease. And you know who recognized that? Rest in peace was Jimmy Carter. Jimmy Carter undid his own presidency by appointing Paul Volcker as chairman back in 1979. It's a social disease. Inflation is a tax on the most vulnerable parts of society, the poor and the elderly. And it will ruin your re-election prospects, as we saw with Jimmy Carter and as we just saw with Joe Biden. So I would just say that if Donald Trump creates the conditions for an inflation cycle, that will seriously impair his legacy. So I always have to operate under a degree of rationality. Maybe with Donald Trump, that's a mistake. But no, I think that the Republicans in the House in particular, and there's a lot of fiscal conservatives there, understand how inflation is damaging for the economy, but also damaging for their own re-election prospects. So make a short story long, but maybe go back and just conclude, I am not buying in one iota to the inflation narrative, full stop.
So you said you're not concerned about inflation, but you did mention unemployment. Where do you see the unemployment rate going? Does it go to 4.5% or 5% by year end?
I think it will go into that range, and that's well above the Fed's current. I mean, they're doing a lot of pivoting. I call him Powell the pivoter. Yeah, I think that the unemployment rate will go into a 4.5% to 5% range because of the signs of weakening labor demand that I'm seeing. We'd already be there if it weren't for the fact that after the horrible experience of COVID, and then companies couldn't find their employees anymore, and it created that huge disruption in the labor market. Companies are loathe right now. They'll cut their hours, but they won't cut the bodies. And it's very interesting when you look at the data in the U.S., because you talk about these non-farm payroll reports, but I didn't hear you talk about what's happening with part-time and full-time, right? So we're getting all these jobs, they're part-time. Full-time employment hasn't grown at all in the United States in the past year. This supposedly red-hot economy hasn't created a single full-time job. So cutting hours, moving people from full-time to part-time, that usually presages the very painful decision to have to let people go. But you see, that hasn't happened yet. That hasn't happened yet. We've already seen the unemployment rate go from 3.5 to 4.1, as you said, without there being any firings. Imagine what happens when we see the firings. So the unemployment rate is going to be surprising to the upside, and it's not Armageddon. It's not the end of the world. It's just the cycle. 4.5 to 5% is not horrible. But would it represent a technical recession, which nobody believes we're going to have anymore? The answer is yes, it would. But I think that's where the unemployment rate's going. That's going to be a drag on wages. And even Jay Powell has said repeatedly that there's no inflation coming out of the labor market. And that's at a time where we're at 4.1. To which I say, well, if we're not getting inflation out of the labor market, where's it going to come from? Really, for you to have an inflation view, you need the labor market to play ball with you. So again, that's why I think the inflationists, and they're entitled to their view, for sure, creates a nice debate. But I'm on the other side of that trade.
I want to ask you about interest rates and the yield curve now. You have said in the past that the real trouble begins when the yield curve normalizes after being inverted. And we have seen that in the past year. And just here in the last few months, the yield on the 10-year has gone from 380 up to 460 or 470. And what is that telling us? And are you concerned that the Fed is losing control of the long end of the curve?
I know there's some people that believe that. I don't believe it. I think that the Fed. The first thing is that although the Fed cut rates aggressively at the September 18th meeting and then cut again in December, as you had accurately said, at the same time they were talking the markets out of pricing in rate cuts for this year, and now we're down to basically just more than one. We used to be multiples. And that's what mattered the most. This is a case in central banking. Words matter more than actions. So it's like the leaky boat. They cut rates and then they talk the market into pricing out further rate cuts, and then the yield curve steepens because the front end of the curve will rally on the actual rate cut, but then the longer term part of the curve will see, this is going to be a truncated easing cycle. And that's really what's happened. You layer on top of that the term premium, which is reflecting the uncertainty around Trump's policies. And that's what's caused the back end of the curve to go up in terms of yield and steepen it. It's hard to know. It's really hard to know right now what message the yield curve is sending you. I think there's really two things, and it's not about the economy. It's directly. It's about the Fed's reaction function. And it's about concern that that fiscal policy is going to remain in a state of disarray. So I think that there's a fiscal premium at the long end of the curve. The Fed has been able to pin the front end by its own actions. And now they're saying they're going to pause for the next several months. There's not a full rate cut priced in until July. The back end is reflecting Trumponomics. In a sense, it's not about inflation expectations. It's about two things. The deficit's not coming down, despite Elon Musk. He wants to cut taxes. Of course, he wants to cut spending, but there's not enough spending to cut, unless you're going to attack entitlements, which he said he's not going to do. And so that's what the bond market's telling you. There is a fiscal uncertainty premium that's keeping long-term rates elevated. The Fed's already anchored the front end, so the yield curve is steepened. I don't know what the economic message is. It's hard to say. I had fully expected that we were going to see a recession by now, but we haven't. And there's a reason for that. And if you remember, I said that in my business, your assumptions drive your conclusions. And if your assumption is wrong, well, ipso facto, your conclusion is going to be wrong. My conclusion was wrong. And where I was most wrong, and it comes down to, the data that we were first talking about, and this is what's not included in private sector surveys. And it's not included in the Beige Book because the Beige Book are surveys of business executives across all industries, is all the government spending that's going on in the United States at this very moment as we make this transition. $2 trillion deficits year in, year out, 6% of GDP. 6% of GDP. This will be the third year in a row of a deficit in the United States of 6% plus relative to GDP. Unheard of, unless you're fighting a recession. So you see, it's interesting, I'm being told there's no recession, but we have a fiscal policy in the United States, the beloved United States. Marx and Engels are probably just smiling in their grave. We're running a fiscal policy aimed at fighting a recession, but there's no recession. We have fiscal policy fighting recession, but there's no recession. It's like a cognitive dissonance. So all this fiscal stimulus is what clogged up all the monetary policy tightening that I was expecting was going to generate a recession. This is unprecedented, unless you're fighting a war or unless you're fighting a disaster like COVID, or you're fighting a recession. We have a fiscal policy that's aimed at fighting a recession that apparently doesn't exist. Think of how illogical all that is. Government spending in the United States is up double digits. Even the R&D spending related to AI is not going up as fast as government spending is right now. You have a growing economy in the United States. We can debate whether it's 3% or 1% or something in between, okay? Government revenues are down year over year. Government revenues are down year over year. You know why? Because not only the spending, but all the subsidies, all the tax subsidies, right? The CHIPS Act, all those subsidies, EV subsidies, default relief, debt relief for students, all this stuff. So for the first time ever, we have an expanding economy, but we have revenues going down. Revenues usually go down for Uncle Sam when you're in a recession. So there's so many strange things happening. But what really caused me to get my call wrong was I did not see that we were going to go through this elongated period of such fiscal support, government support. The average OECD country outside the US is running a deficit GDP ratio of 3%. We bellyache about Canada. I don't believe that Justin Trudeau, ultimately got turfed out because of fiscal policy. I just think basically people got tired of him. Canada's deficit is 2% of GDP, throw in the provinces 3% of GDP. That's why interest rates are so much lower in Canada, is we do not have that same degree of fiscal stimulus. So back to the question, the steep shape of the yield curve is reflecting the doubts that the market has that Trump will be able to rein in the deficit. And although I've been bullish on bonds, the only friends the bond market has right now is the Freedom Caucus, those 38 fiscally conservative members in the House. The question is, will they stand their ground or will they get bullied, right? Trump had to get off the golf course, think about that, to get on the phone to save Mike Johnson's job as Speaker of the House. He got off the golf course to make the calls. So a lot will depend on the fiscal side, what happens in the House, because the Republicans only have a one-seat majority. So that'll be very interesting to see, because if left unchecked, the deficit's not even going to be $2 trillion this year. It's going to be more like $3 trillion. We have the first 3 months of the fiscal year. the deficit's up like 30 or 40% from where it was this time last year. So that's what the shape of the curve is telling you. No other economic message other than concerns over the state of fiscal policy in the United States right now, which have yet to be resolved.
So just a lot of uncertainty. Do you see a threat of the 10-year going to 5 or 5.5% in the coming months?
Well, I could tell you I'd be buying the bleep, 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 bleep out of it if that were the case. There's always the risk of an overshoot, and you have to recognize that. But I think it'd be a great buy. I think it'd be the last time we got to 5% on the 10-year note in October of 2023 was a great buying opportunity. And remember, there was one point in September of last year we got to 365. So I'd say that would be a very nice buying opportunity. Is it possible? 100%. But it would, to me, classify an overreaction. There are conditions that can take us there. I could be wrong on the inflation call. I could be wrong. It could be that the spending cuts don't amount to anything, that he cuts taxes, overly stimulates aggregate demand, that productivity doesn't hold up as much as I thought, because inflation is about supply and demand, right? So you have to have a base case scenario. I do have confidence in that forecast, but it's not. There's no such thing as 100%. A lot of things would have to happen to break 2 or above 5% from where we are right now. But I would say that would be one great buying opportunity, and that something I just said reminds me of something I want to come back to, because everything you had mentioned about tariffs and immigration and so on and so forth, all inflationary. And you mentioned Paul Tudor Jones, who I know very well. But we didn't talk about AI. We didn't talk about AI. If the stock market is right about AI, the stock market's right about AI, then we're going to have a productivity boom. You cannot justify the valuations in the stock market today unless you believe that AI is going to drive a major productivity boom that will cut corporate costs and boost productivity, boost corporate profitability at a rate that will be triple the historical norm over the next 5 years. That's what the market's telling you. Well, you don't need to do much more than get through first-year economics to know that productivity is an inflation killer. If you think that there's going to be wage increases, well, really? The robots are coming after our job, by the way. The robots. So ChatGPT, all this stuff, is going to create a lot of job uncertainty. And it's going to create tremendous productivity. We don't know how much. Nobody talks about that. They talk about tariffs. They talk about tax cuts. All this stuff is all inflationary. But inflation is a complex thing. There's a lot of factors that influence it. But what I'll tell you is that productivity has a time-worn inverse correlation to inflation. And nobody talks about that. You go to the last set of FOMC minutes, it's all about Trump. It's all about Trump. Hardly anything about AI and what that's doing to productivity. So that's just another layer of analysis that leads me to that view that inflation is not going to be a problem, and that if for whatever reason bond yields ratchet up further, I mean, sentiment on bonds right now is so depressed. It's like almost as depressed as what sentiment was in the stock market back in March of 2009. So if you're a contrary investor, you have a contrary antenna at the bond market. I mean, you can pick up right now, Jimmy, you can pick up almost 5% in the 20-year part of the curve right now. You can actually get almost 5%. With inflation, most of the inflation measures are running close to 2%. Not 3, close to 2. The ones that count, like the core PC deflator, will probably be at 2% by the end of the first quarter. And you know, almost 5% that you can garner in a 20-year Treasury. I'd say you probably pick that up right now.
You mentioned you're very concerned about the deficit, and when Trump first came to power in 2016, the federal debt was at $19 trillion. The deficit as a percent of GDP was 3%, Now the federal debt's at 36 trillion. Hard to believe. I can't believe these numbers, but the deficit as a percent of GDP, as you mentioned, is at 6%. Do you think Trump and also Scott Bessent, the new Treasury Secretary, can get these things under control? And I think their target is to get the deficit as a percent of GDP down to 3%. Is that feasible in the coming 4 years?
Yep, it is. It is. It happened. We had a huge decline in the deficit GDP ratio under Barack Obama, but of course it wasn't him, it was Congress. So the House in particular will have a big say on how this happens. Trump already said in the election campaign, because he wanted to get elected, he wasn't going to touch entitlements. That's unfortunate, because without small changes to entitlements, just small tweaks, they can have a very powerful actuarial impact on those deficit projections. But he's not touching entitlements because, of course, they're entitlements. You're entitled to them. They were brought in the 1930s during the Great Depression, and like everything else, what is supposed to be temporary becomes permanent. We're not going to inflate our way out of it. I don't know if we're going to grow our way out of it. Maybe AI and ChatGPT and these generative chips, maybe we will grow out of it. Who knows? Look what the internet did. It's interesting. Look what the internet did. Really, 4 years after Netscape went public and brought the internet to the masses, the U.S. government is running fiscal surpluses under Bill Clinton. Bill Clinton cut taxes. So it can happen. That will come down to the extent to which this shift in the innovation curve, which is what it is, will generate the revenues that will cut into the deficit. I'm not banking on, okay, so Trump's going to freeze civil service employment. That doesn't impress me too much. I mean, you want to get to Elon Musk's $2 trillion target of spending cuts, you're going to have to let a lot of civil servants go, not just freeze. It's going to be a tough task. But the key will be this AI craze and what that does to productivity, especially at a time when we're not going to have the same growing workforce, because as you mentioned, immigration is going to be a constraint. So we're going to need productivity as a source of economic growth from the supply side. So I'm not going to say nothing is impossible. It's doable, but I come out more skeptical. But it really will be AI being the driver of those revenues. The tax cuts themselves, if he gets them through, they're not going to pay for themselves. And don't forget, he's not just talking about tax cuts for corporations, getting the top rate down to 15%. He's talking about no tax on tips, no tax on overtime, all these nice, I was waiting between him and Kamala Harris during the campaign, what's next? Like root beer in the water fountains? Is that going to happen too? And now we're talking about the SALT deductions. All this stuff adds up. So there's reason to be skeptical. You mentioned about the fact what the debt is now compared to when Trump took office. The debt to GDP when he took office in 2017 was 100% of GDP. Now it's 130%. But what's more pernicious is how structural it's becoming. They're following in the footsteps of Canada of the early 1990s, because when he took office, and this is the most important statistic, in Trump 1.0, the interest coverage ratio, or let's call it what is debt service costs absorbing out of the revenue pie, was 8%. Today it's approaching 20. And that's the big problem, is that interest costs are starting to eat up a larger and larger chunk of Uncle Sam's revenue stream. And when you start breaking above 25%, then you start running into trouble, even the reserve currency. That was the Canadian situation back in the early 1990s. When that ratio broke 25%, the interest cost in the debt and how it ensnared fiscal finances, that's the big concern. is what's happening on the interest on the debt. So that's when it becomes increasingly structural. That's when you start getting nervous about the Treasury market. Tailed auctions, maybe even a failed auction, God forbid. And that's why this has to be tackled now. The only body that's going to tackle it, like I said, are 38 Republicans in the House. They either have the courage or they don't, but we're going to find out probably in the next 6 months.
David, I want to ask you about the stock market now. You did express concern about the economy, so I want to see how this impacts the stock market. 2024 was one hell of a year. Both the S&P and the NASDAQ were up 25%, give or take. 2023 was also a great year. We've seen many stocks up 100, 200, 300% in the past year. And there are 9 stocks now in the US that have market caps greater than $1 trillion. But I want to get your views on the stock market valuations. And are you concerned about the valuations and the craziness that we're seeing in the markets right now?
Right. Well, look, a lot of stuff to unpack there. This has been a virtually unprecedented momentum-driven market. Not principally, but mostly. So you mentioned that the return was 25% in a year where earnings were up 8%. So the market went up triple what earnings did. It's interesting that at the end of 2023, the consensus among the top-down strategists was that we were going to finish 2024 at 4,900. They were basically saying the stock market's going to go up with earnings. We blew through 4,900 in the first quarter of last year. And then everybody is chasing the market. Everybody's chasing, and everybody's adjusting their numbers higher because they can't fall behind. And even though the earnings fundamentals that were expected didn't change, the price of the market changed. And you had a 4-point multiple expansion in the S&P 500, which is basically a 2 sigma event. So that's how you explain this market. It's momentum-based and animal spirits, which means there's a lot of psychology. I said before, to be an economist or financial market pundit, you have to be a lot of things. And you have to be not just a historian, but also a psychologist. Animal spirits was the term coined by John Maynard Keynes, and it didn't apply to the economy. The economy is not the stock market. GDP is not a listed stock. Animal spirits refers to the extreme emotions of fear and greed. Maximum fear in March of 2009, maximum fear in March of 2020. And now we have maximum greed. Gordon Gekko is smiling somewhere, maybe from prison. So that's really the market we have. I wrote a report. We got the data from the Census Bureau. It's called the American Time Usage Survey. And I wrote a psychological report on the American household. Where are we spending our time? How are we spending our time? The we as in Americans, probably Canadians are much the same. How are we spending our time differently post-COVID? It's a fascinating, and I've got to say, I've got some clients that are actually psychoanalysts and psychologists, and they wrote me back because I wrote this whole piece. How are we spending our time sleeping, more time thinking, more time relaxing? But they're not really sleeping, right? What happened was during COVID was the government gave us a pile of dough, and we had nothing to do. We had nothing to do. We couldn't go anywhere, but we had a pile of dough that the government gave us. So what did we do? The collective we. We became day traders. Did you notice that Reddit, Robinhood, all this stuff, all this momentum day trading by young people didn't happen before COVID, happened after COVID? So everybody's a day trader now. I go into an Uber and I'm on the phone. When I get off, the Uber driver is talking to me about the markets. I got my hair cut yesterday. Thanks for the compliment. And the barber is talking to me about the markets. I'm waiting for the street sweeper to talk to me about the markets when I cross Bay Street after this show is over. You know, it's rather incredible. About the stock market, everything you said was correct. It is very concentrated. Over, well, 42% is in technology and telecom, which is the exact same concentration in the market we had back in March of 2000, if you remember. Yeah, I think that we are in a price bubble. We're in an official price bubble because I look at the CAPE, the Shiller cyclically adjusted price earnings multiple that goes back to the 1920s. And at 37, we've only been this high before in 1929, 1999, and for a brief period at the end of 2021. And neither of those years were followed by a very good outcome. Now, they say valuations aren't a timing tool, and I agree with that, but valuations at any point in time represents whether you have the wind at your back or the wind in your face. But you see, and everybody always thinks they'll be able to time the exit, and inevitably they don't. So we have, when we have a 2 standard deviation event, right now it's 2.3. There's no other stock market in the world, by the way, including Canada. No stock market in the world has its CAPE multiple anywhere close to where the US is. There's no country that has a 2 standard deviation event right now, and not Canada. Only the S&P 500. So it is a price bubble. Price bubbles can last a couple of years. You know, you could argue that this thing really got going at the end of 2022 with ChatGPT, and now we're in early 2025. So time could be running out, but nobody can ever time when a bubble is going to pop. But we have to ask ourselves the question, why is Warren Buffett sitting on 30% cash? He's never done that before. In his 60 years, he's never done that. What is he seeing? The classic value investor. But he's seeing what's happened in terms of the valuations. Price is what you pay, and then your future, the value of your future cash flow stream is what you get. 30% cash. But then again, cash is paying you close to 4.5%. You might look back at the end of this year thinking 4.5% was a home run. There are years where that happens, but nobody expects it right now. But I'd say that the U.S. stock market is in it's not as big a bubble as it was in the late 90s, but you don't have to go there. But it is in an official 2 sigma event price bubble. And when we looked at actually the data, we looked at what are the returns over the next the 1 year, 3 year, 5 year, 10 year return in the S&P 500 when the CAPE is where it is today. And in no time period is your future return positive. In every time period, you're better off being in cash. So that's the deck of cards that we have right now. I do intend on becoming bullish at the first opportunity, but the valuations are going to have to improve markedly. And that's where I stand on that. Momentum markets, I tend to avoid those. I'm more of an old school fundamentalist. I would respect a market. Already the multiple was already quite high going into 2024. And then we had the market triple what the earnings did. If I told you that earnings are going to go up 8%, would you say, oh, the market's going to go up 25%? Really? And the starting point is like a 17, 18 multiple. It's not like it's 12 or 13. But that's what happened. What I find fascinating is I will readily admit that we've had a shift in the technology curve, that this generative AI is a serious deal, and it is a game changer. There's some people that believe it's as big as the internet. I'm not quite there. But there's been a shift, and investors have lengthened their time horizons. So we went and looked at the past 100 years worth of data to see, firstly, what is the normalized 5-year earnings growth projection embedded in the stock market at any moment in time, and that number is 8%, 7 to 8%. At the time of ChatGPT, it was about 10%. That's the 5-year expected annualized growth rate in earnings per share. Where is it now? Over 20%. About triple the historical norm. The market is already telling you. See, that's why I think a lot of this is already priced in. The last time that we had 20% earnings growth priced in for 5 years was back in the late 1990s. So these are great companies, make no mistake. These are great companies. It's just the stocks that are just, there's too much priced in. If you believe that, there's some people believe that we're going to get 30% earnings growth. Well, for you, the market's cheap. But I'm not so certain that we're going to get 20%, which we didn't. We didn't get that with the internet when all was said and done. And of course, these stocks corrected. They called it the dot-com bubble. It wasn't a dot-com bubble. It wasn't all about pets.com. You had companies, they all got caught up in the same mania. Microsoft, Intel, Cisco, IBM, Dell, they all got caught up and they all collapsed. Those stocks were down 60 to 80%, 60 to 80%, and then it took them a decade to get out of the penalty box. And these companies are still around today. These are great companies. These are great companies. Microsoft involved once again. Great company, not necessarily a great stock. And when I hear about that, you know, that, oh, well, there was no business models in these dot-coms. And it wasn't just a dot-com rally. We called it TMT. I was at Merrill Canada back then, technology, media, telecom. And it wasn't just about dot-coms. You know, Nortel was not a dot-com. And these were companies at the time that had cash flows, they had business models, they had real profits, just like these companies do today. And that's always the comeback to my view. Well, the companies today, they have real business models. NVIDIA, they have real earnings. I get it. These are real, they're great companies. I just don't believe they're very good stocks. And my money is with Warren Buffett on this one.
When you look at the tech bubble of the late 1990s, the S&P peaked in March of 2000. And in the ensuing 2 years, it was down 50%. The NASDAQ was down 80%. Do you see that happening under the right situation? You made mention of the fact that you're concerned about the unemployment rate ticking up. And if we get that, we're going to get a slowdown in the economy. Would that feed into a significant pullback in the S&P and the NASDAQ?
Well, it would be, the answer to your question is yes. And it's happened in the past. And it comes down to the old adage, the higher they go, the harder they fall. We're talking about a 2.3 standard deviation event. So we're coming off, which we will look back. We will look back. We will readily admit that this was a price bubble. Now what happens is that you get the mean reversion. Multiples mean revert. Multiples mean revert. People thought there was a new era with the internet. The internet was a new era. It affected your life and my life, affected our lives personally and professionally, much like AI will do the same. But the markets are the markets. And even as all this stuff was going on, the internet was still influencing our lives and improving productivity. And during that whole period, in the mid 2000s, these stocks were in the penalty box, even though this technology was changing our lives in a real sense. The markets are the markets. Yeah, so I think that there's a chance that that could happen. I'm nervous that's going to happen because when you mean revert, the mean reversion, we talk about the mean is just a horizontal line. It's the average. If you ever take a look at any of these ratios, price to book, price to earnings, price to sales, home price to rent ratios, any ratio in the marketplace, mean reverts. Bob Farrell's rule number 1. These things mean revert over time. But the mean's a horizontal line. And whether you're going up or going down, you never stop at the mean. So back to your question about 50, 80%, which people have to know, is you always get an overshoot to the upside and an equal overshoot to the downside. That's my big concern. Mean reversion means that you correct two extremes. That's a pretty scary thought. What also has me scared for society is everybody is all in on the same trade at the same time. We get the Fed flow of funds data. When you look at the US household asset mix, 70% is in stocks, 10% is in bonds, 20% is in cash. 70% is in stocks. Never been that high. The boomer community, my community, 60% of the asset mix is in equities. It should be 30 to 40 based on the life cycle. But risk on, baby, risk on. And the momentum trade has worked. It'll work until it doesn't work anymore. But everybody is all in. The concentration of risk on household balance sheets is unprecedented. And the stock market itself has only been this concentrated in these high-flying technology names only one other time in the past. And that was in the late 1990s. Layer on top of that, ETFs, passive ETFs, index funds. Index funds. The active management community is bleeding outflows, and they're closing up. Everybody's buying these low-cost ETFs, well, because they're low cost, and they're buying the index, but they're buying a very concentrated index. The passive ETFs, everybody is buying, and now it's almost 60% of the market. You know, when John Bogle unveiled, the Vanguard ETFs, index funds back in the mid-70s, he said this will never get over 20% of the market cap. We're getting up to 60%. People don't even know, for crying out loud, what it is they own. The old days, you had your broker. Your broker had 12 stocks. He'd call you and saying, we're going to blow out IBM and buy Exxon. You knew what you were holding. People now they have the index, they don't even know what it is they own. They have no clue what it is they own. They only know that the stock market, because this is what happens, your mind gets fuzzy when you're up 25% 2 years in a row. And people then extrapolate that into the future, which is a big mistake. As Herb Stein famously said, Richard Nixon's chief economist, anything that can't last forever won't. Chuck Prince, CEO of Citigroup in July of 2007, that was a huge momentum rally back then, said you got to keep dancing until the music stops. Do you remember Chuck Prince? He was the CEO. I don't know where he is today. Keep dancing till the music stops. And the music stopped 3 months later. Who knew what was going to happen next? And that stock market, that was the housing bubble. That stock market, which was in a mania, was not in a bubble. This is a bubble. And look what happened to that stock market back in 08 and early 09. So I'm concerned that everybody is all in on the same trade at the same time. And what happens when they try and exit? These active fund managers, they're trying to stay in business, for them to match the market, they have to take on extreme concentration risk. These are professional people, right? These are not indexers. The index has to take the money in from the general public, the 401ks, and then invest it. They invest it right back in the market. They're not making an asset mix decision for you. Like your broker, your active manager will make a decision between, should I buy bonds, should I buy stocks, how much should I start to raise cash? Your passive ETF doesn't do that for you. You're just blindly buying a concentrated stock market at historically high valuations, but nobody seems to care. But when the momentum, that's the thing about momentum markets, is momentum markets will ultimately move in both directions, and then people will panic. People will panic. But it's about the size, because 70% of the household asset mix is in equities. What happens then? They're going to sell. They're going to be selling these ETFs. But here's the problem. Who's going to be representing the bid on the other side of the trade? Because everybody is all in. Everybody is all in. I guess I will be there to help pick up the pieces because I got a lot of liquidity. And I guess Warren Buffett. No. if you put me in the same room as Warren Buffett and we took the average, David Rosenberg would be a billionaire. So he'll be able to pick up the pieces because he's got a lot more cash than I do. But that's what I'm saying, that the people, I'm trying to explain to them about what's rational right now is to raise liquidity. But nobody's listening to me because the market keeps on going up and people think it's a permanent situation when nothing in life is permanent. When it rolls over and you're going to see the outflows, these passive ETF outflows, I think that it could get pretty ugly. You ask me what keeps me up at night? From a market's perspective, it's what happens if that panic sets in. There's a lot at stake. Everybody is all in. Everybody is all in. And that has me concerned.
I want to get your views now on the Canadian economy. And the Canadian electorate has a lot in common with the Americans. We're concerned about inflation, we're concerned about immigration, but there's one issue that we have that the Americans don't have, and that is a lack of leadership at the federal level. And just to provide some context for our viewers, our Prime Minister, Justin Trudeau, has resigned, and he's still the Prime Minister, and he's going to stay so until March when the Liberals have a leadership race. But until that time, there's a lot of turmoil, both at the federal level and at the provincial level, and we're really sailing without a rudder. And it couldn't happen at a worst possible time because we have this pending trade war with the US. And a lot of the troubles we're experiencing right now existed long before these recent troubles have started. The Canadian economy, as measured by GDP, has been in decline for many quarters now. Labor productivity has been in a decline for many years. Unemployment's ticking up. I believe the last number was 6.5% in the province of Ontario. I think the number is 7.5%. What's your view on the Canadian economy?
Okay, well, let's just say that, starting off with your first comment about political instability, I would say that the U.S., a lot of people would agree that the U.S. was rudderless from a political leadership standpoint for 4 years. Canada's not alone. Look what's happening in the UK right now. Look what's happening in France and Germany. Political changeover in Italy and in Mexico. And Modi's power base eroded in the past year with their election. There's political upheaval around the world. There is dissatisfaction with incumbents around the world. Canada is not alone. So this will get resolved. We're going to have an election probably sometime, I would imagine, in the spring. And if you're going to ask me, no matter who wins the Liberal leadership, I think Pierre Poilievre probably emerges as the Prime Minister. And pro-business, pro-market, there's a lot of reasons to be hopeful about political change in Canada in that respect. So just like we were hopeful after we replaced Pierre Trudeau with Brian Mulroney, it wasn't the worst thing for the Canadian economy or the markets, or what it meant for deregulation in Canada, what it meant for tax reform, all the stuff that Mulroney did, which is really positive. And I think Poilievre will be very positive for the Canadian economy and the capital markets. I'm a capitalist, by the way, so other people might have a different opinion. But I think Poilievre, a majority Conservative government, will be a game changer. How we fight the tariffs, I don't know if we can. We'll see what Trump's going to do. I don't think there's much we could do about it, except cut interest rates dramatically and weaken the Canadian dollar. I think we get into a tit-for-tat trade war, and not good news for us. We ship over 20% of our GDP to the United States. The United States ships 1% of its GDP to Canada. It's not an even relationship. And I'm a little nervous that we're going to try to play tit for tat. Sometimes, you're fighting the bully in the schoolyard. You get a black eye. You try to fight back, good for you, then you get 2 black eyes. I'd rather not get 2 black eyes. So we'll see how these things unfold. But I think the political outlook in Canada is actually, good. We were going to have an election anyways, no matter what, in October, and now we don't have to wait that long. So I'm taking a more optimistic view of the political outlook here in this country.
So you're confident about the political landscape, but what about the economic?
A lot of these things are out of our hands. If Trump brings on that 25% tariff, it's going to be horrible. I mean, there'll be a deep recession in Canada. It'll trigger a 2% decline in real GDP. That doesn't sound horrible, does it? But it is. GDP is not the stock market. I don't, it's as if I would tell you the stock market's going down 40%. The economy going down 2% is a big deal. We'd lose over 400,000 jobs, and the unemployment rate would go 2 or through 8%. Now, people think that we're going to respond. We'll see how we respond. We're going to choke off our exports to the U.S. I don't think that does us a whole lot of good. Are we going to have to take it? Maybe we will. I think there's other things that we could do to combat it, which is cut rates dramatically. And it's natural to have the country that's having the tariffs imposed, it's natural to have their currency decline as an antidote and at least a partial offset. And I think that's probably what's going to happen. We get into a trade war with the United States, that we slap on tariffs, we do a tit for tat. I don't want to get into a prolonged fight with Donald Trump. We don't know where it's going to end. We only know that we need them more than they need us. So things are pretty weak as is. You could argue technically we're not in a recession, but let's face it, 7 consecutive quarters of negative real GDP per capita, not a good look. Justin Trudeau was the only prime minister Canada's had that presided over practically zero growth in productivity and zero growth in real GDP per capita. Nicely done. And we'll see what Poilievre can do, because we know that immigration is going to be constrained going forward, which is not the worst thing in the world, coming off the levels that we've had. What is going to happen to engender a productivity revival in Canada? Because that's really what's been missing from the supply side. But what I can say is that the negative aggregate demand shock from what the Trump will do, if he does what he says he's going to do, and not knowing what our response is going to be very bad news for the economy. Very bad news. And rates will come down, the Canadian dollar will come down, and you can make an investment thesis in the Canadian stock market right from there. It will not be nearly as bad for the Canadian stock market as it will be for the Canadian economy. But just remember that the TSX, like the S&P, is not part of it, so it's not GDP. But there's going to be important areas to focus on bullishly in Canada if these tariffs come through. You have to know what to avoid and what not to avoid.
You just mentioned the Canadian dollar, and I should have mentioned that it was down 10% in 2024. It's at a 14-year low against the USD. Where do you see the Canadian dollar going?
Well, I think that if Trump does, as advertised, this 25% blanket tariff, I think the bank will have to take, we're already gone from 5 to 3.25 on the policy rate. I think we'll go down well below 2% into the ones. Canadian dollar in this environment, because the Fed will be on hold, the combination of the shock and what the Bank of Canada will do leads us to a conclusion that the Canadian dollar will get to around 160, so call it 62, 63 cents. And that'll create winners and losers. I think that it obviously is going to have an impact on food prices, and that's the most important thing. And I think that, as I said before, despite the horror narrative, our fiscal policy is not out of control. The U.S. is far worse. We can afford to have rebates for low middle-income households to offset the shock, especially on food. I mean, other stuff won't go up. I mean, rents won't go up. But imports prices will go up, especially for things that you need to live. The government has to protect those people. Maybe not me or you, but there should be a system. That's what I would be thinking about instead of playing tit for tat, choking off oil, electricity, all this other stuff. That's not going to help our economy. Okay, it's like bringing a butter knife to a gunfight, and I don't recommend that. There's other ways that we can cushion the blow. I think we got to focus on cushioning the blow, not teaching Donald Trump a lesson. That is not going to end well for us. That's also a memo to Doug Ford. It's not going to end well for us, okay? We got to deal with the situation. And I think that we should play defense and think about how we're going to cushion the blow rather than retaliate. That's my advice. But the Canadian dollar will weaken, and that's going to create a travel and tourism boom in Canada. Can I quote Donald Trump? At travel and tourism in Canada, like nobody's ever seen. And because Americans will see, like right now it's 40% discount, 60% discount on the Canadian dollar. They're not going to spend 1 week in Quebec City or Whistler, they'll spend 2. Travel, tourism, accommodation will be a boom. I think the airlines, cross-border, because what's Trump going to do about that? What's he going to do? Is he going to have troops at the border? You can't go into Canada. The way you get back at Americans is have the currency so cheap that they're going to, he wants to create a 51st state, but maybe there's a lot of Americans that are going to be staying a long time in Canada because look at what the US dollar buys in Canada. We were talking before about, went out for dinner at this high-end local establishment on Avenue Road that everybody knows. It's a great restaurant. And a client of mine was there from the States, a firm, and they invited some other investors. There's 10 of us in the restaurant. And the head sales guy who took everybody out from New York could not believe. This is one of the most expensive restaurants in Toronto. He said, can't believe how cheap this is. I said, well, the Canadian dollar is 144. Wait till it's 160. When it's 160, like you'll be ordering a bottle of Dom Perignon, So that's actually, how we will get back at the Americans. And then, of course, the comeback is, well, that's going to really hurt us from imported inflation. Well, the imported inflation that's going to be most important from a social policy standpoint is food. Okay, but there's a way through fiscal policy that we can also circumvent that blow to low and middle income households. That's what I'd be doing if I was in Ottawa.
So you've expressed a lot of concern about the U.S. economy and also the Canadian economy. What are you recommending to investors? How should they position themselves during this time of uncertainty?
Well, let's talk about the stock market first. I said before, the U.S. is in a different orbit. Great companies, stocks they're in nosebleed terrain. The only stock market in the world that is a 2.3 standard deviation event. That is extreme. No country shares that dynamic. Well, some of the cheapest markets in the world, for example, are in emerging Asia. But as Don Cox famously said, emerging markets are markets that you can't emerge from in an emergency. So and of course, China is a big part of the emerging market world, and they're going to get hit with a tariff, and they're dealing with the ongoing aftershocks of their the bursting of their property and debt bubble. Question marks around China. But you have some of these countries have single-digit price earnings multiples. You're salivating as an investor, but then you start thinking, as you're going back and forth, do I put money in emerging markets? But maybe they're cheap for a reason. Maybe they're cheap, but they're cheap for a reason. Okay, then you go to Europe, same thing. The European market, dirt cheap. You have all this political instability especially in Germany, France, the UK. UK is a very cheap stock market, very attractive, but you got fiscal problems. The problems over there are much worse than they are in Canada, okay? Their inflation is more sticky. Canada does not have sticky inflation. And Canada doesn't have really a massive fiscal problem. We talk about it a lot. There's a big household debt problem in Canada. Europe is cheap, but maybe once again, like emerging Asia, maybe it's cheap for a reason. Canada's trading at a 15 forward price earnings multiple. When you look at the Cape, we're trading bang in lines, very strong neutral. We're not anywhere close to 2.3 standard deviations. We're just closer to the norm. US is trading at a 22 forward multiple, we're at 15. 7 multiple point gap. It's almost unprecedented. It's like Canada's for sale. When something goes on sale, you don't normally want to buy it. Not just that, and I didn't mention this before, but look at the bond yields that the TSX is competing against. The bond yield in Canada is what, 3.25%. In the United States, it's 4.6. The US market is competing with a 4.6% 10-year Treasury note yield. What has happened in the US, which is truly ridiculous, is you have an equity risk premium of 0. You have an equity risk premium of 0. The ERP is 0. What does that mean? It means that you're not getting paid as an equity investor to take on equity risk. The market is, we start off talking about the market. What is the market telling us? The stock market in the United States is telling you that equities have become a riskless asset class. Equities have become a riskless asset class. Think about that for a second. Equity investors are putting the S&P 500 on the same risk characteristic as Treasury bills. Well, Jimmy, how do you feel about that? I know how I feel about that. When you have the equity risk premium at 0, the market's telling you this collection of 500 stocks, it's not totally 500, are basically collectively 0 beta. There's 0 beta. Last time this happened, late 90s. I'm just not good enough to know, is it like 97, 98, or is it 99? But I know that I'm not going to chase nickels, dimes, and quarters in front of the steamroller right now. The train has left the station. So in Canada, quite a bit of difference, because the equity risk premium in Canada is 3%. You get paid. You get paid to take on equity risk in Canada. The stock market is paying you to take on that risk. In the United States, the market is not paying you to take on that risk. Not just that, but look at the dividend yield. The dividend yield in the S&P 500, do you know what it is? You know what it is? It's 1.2%. Does that get you excited? Doesn't get me excited. I like dividends. I'm like Mr. Wonderful. Cash flow. Canadian, the TSX dividend yield, 3.2%. Really? That sounds enticing to me. And so when I take a look at what's going to happen in Canada, which was already happening before the tariffs come, it'll reinforce it. Much lower rates with your Canadian dollar. The tariffs come, you got to avoid the stuff getting hit by the tariffs, which is industrials, consumer goods, basic materials. But there's going to be a lot of stuff like, what tariff is Trump going to put on the banks? Is there a tariff he can put on the bank? He's not putting tariffs on services. He's putting them on goods. So you want to own the stuff that's going to do well with lower rates and a steeper yield curve. Financials, REITs, utilities, telecom services. And the weaker Canadian dollar is going to be a boon for travel and tourism. All the stuff I'm talking about right now that's going to benefit from lower rates and a weaker dollar accounts for 50% of the TSX. The stuff that's going to get hit by the tariffs, that's 30% of the TSX. So people will be surprised that even though this is going to be horrible for the economy, it won't be nearly as horrible for the stock market, and especially if you're in the right sectors. So I wrote this report, at the beginning of the year that said, the title was Attention US Investors, Leave New York and Come to Toronto. Because don't forget, the added kicker for them is they're getting the Canadian dollar. Even if we go to 160, we're going to be closer to the lows than we are to the peak. We were last at that level in 2002. Around the SARS shock, if you remember, and the bank was cutting rates without the Fed. We didn't stay at 62 cents indefinitely. So Americans get to pick up a much cheaper market with a much better yield in a much cheaper currency. And I tell this because 70% of my clients are in the States. And I want them to stay out of trouble, and I want them to make money in a prudent way. Canada has rarely looked this good. Despite all the warts, scars, and pimples, Canada's rarely looked this good for a stock market perspective relative to the US than is the case today.
And the last time we spoke, you were very bullish on precious metals. Are you still?
I'm still I'm a long-term bull on gold absolutely, and precious metals in general. Why? Because the first thing you brought up, Jimmy, you talked about uncertainty. The word uncertainty showed up 12 times in the latest FOMC minutes. It showed up 6 times in the beige book. We are uncertain with a capital U, bolded, and gold is an effective hedge. There's other attributes. Gold is an effective hedge against uncertainty. And the world's always uncertain, but we're in a different level right now. Like, you want to talk about standard deviations of benchmarked against the norm. We are way above that. So gold is a good hedge against instability. And with all the political instability, what's Trump going to do, not do? And it can go either way. Gold is going to offer up that diversification, bastion of stability in a portfolio in an uncertain world. I think that makes perfect sense. So the answer is yes, I'm still very bullish on bullion.
Nothing better than gold in the hands. Well, David, this has been a great conversation, and I want to thank you very much for sharing your thoughts. If somebody would like to learn more about you and your research firm, Rosenberg Research, where can they go?
So you can just Google Rosenberg Research, and it'll pop right up, and you can surf our website and take a look at what we're doing. And there's a way on the website as well to access a free trial, so you can trial us for free. And short of that, you just have to go to just Google information at rosenbergresearch.com. Information at rosenbergresearch.com, and sign in. One of my client service representatives will get in touch with you. And again, you can taste our wares, read our research. We'll get you on a trial, and then hopefully you'll become a client. You know, we have almost 3,000 clients in 40 countries, and half are general investors, the general public, what we call, quotes, the retail investor, and the other half are institutions. And we cover the world, both in terms of economies and markets. And that's the pitch.
David, once again, thank you.
You as well.